analysis and stock valuation. So this report provides an overview of company analysis and stock valuation, including the two main steps involved in evaluating a company stock. So we will also discuss different types of companies, stocks, and factors that affect company performance. So company analysis, it involves understanding a company's business model, profits, problems, and how it compares to others. So stock valuation, it involves here using mathematical models to determine if a stock is overvalued or undervalued. So it is using the DDM or the dividend discount model to value stock. So types of companies. First is the growth companies. So these companies experience rapid earnings growth and their stock prices usually increase as a result. So example is the Amazon. Second is the defensive companies. So these companies are stable and less affected by economic downturns as they provide essential goods and services. So example is the Johnson and Johnson. Third is the cyclical companies. So these companies are heavily influenced by economic conditions and their performance may fluctuate with the economy. So example is the Ford Motor Company. Fourth is the speculative companies. These companies are high risk and may experience significant gains or losses. Example is the Tesla. So types of stock. First is the growth stocks. So these stocks have rising prices due to expected growth in earnings. So example is the Shopify. Second is the value stocks. So the stocks appear undervalued but can provide good returns if their price increases to match their intrinsic value. So example is the General Motors. So next is the speculative stocks. The stocks are high risk and may experience rapid price fluctuations. Example is the GameStop. Factors affecting companies. First is the economic factors. So like inflation, interest rates, and GDP can impact a company's performance. So for example, rising interest rates can increase borrowing costs for companies. Second is the industry factors. So competition and demand within an industry can affect a company's success. For example, the rise of streaming services has disrupted the traditional TV industry. Third is the structural factors like laws, government policies, and regulations can influence a company's operations. For example, changes in tax laws can impact a company's profitability. So competitive strategies. Competitive strategies like first is the cost leadership. Companies aim to be the lowest cost producers and sell at lower prices than competitors. So examples the Walmart. Next is the differentiation. So companies offer unique products or services that differentiate them from the competitors. So example is the Nike. Next is the focus strategy. Companies target a specific market segment and tailor their products or services to meet the needs of that segment. So examples the Lululemon Athletica. So in conclusion, company analysis and stock valuation are essential steps in evaluating a company's stock. Understanding the different types of companies, stocks, and factors that affect company performance can help investors make informed decisions, like using the mathematical models and analyzing competitive strategies. Investors can determine if a stock is overvalued or undervalued and make informed investment decisions.
Ah, SWOT analysis. S. To strength what the company do well like having strong brand or good product. W. Weaknesses. What the company lacks like old technology or too much debt. O. Opportunity. What the chances of the company has to grow like new market or product. T. Trades. What the problem could hurt the company like new competitor or changing law. Peter Lunch lesson. Embase in what you understand. Choose the company you know like the brand you to use the every day. Uh, Look for the strong growth. Goods the company to grow the share and profit every year. Check, check the balance sheet. Look at the company financial health. Do it have too much debt? Don't follow the growth. Don't don't buy under stock just because every else in the buying in Warren Buffett role. Know the business to only invest you understand how the company market the money. Uh, Find the good management. Make sure the people running of the company are smart uh, and honest to check for the strong profit. The company should earn more than is the spent by after a fair price. Ev- Even that rich the company can be bad investment if the price is too high.
The idea of present value of dividends helps in guessing what future dividend payments are worth today. One simple way to do is the constant growth dividend model. This model has a formula to calculate the real value of a stock based on the next dividend payment and the expected return and the constant rate which dividends are expected to grow. So makita na ninyo ang formula diya na ako gi-attach. So, to figure out this growth rate, you can look at the average rate at which dividends have grown in the past. Another way is to estimate the sustainable growth rate, which is based on how much of the company's earnings are reinvested and how good the company is at making profit on those investments. Figure out the return investors expect from a stock, you need to estimate the required rate of return. This is often done by starting with a basic, safe interest rate and then adding an extra to account for the risk of investing in that particular stock. This extra amount is called the risk premium. One way to estimate the risk premium is by looking at how the stock price has historically moved compared to the overall market using a method called regression. The formula shows that the expected return of the stock is equal to the risk-free rate plus the stock risk level multiplied by the extra return expected from the market compared to the risk-free rate. The present value of dividends model, or DDM, is a way to figure out what a stock is worth based on the future dividends it's expected to pay out. It works best when the expected return on the stock is higher than the rate of at which the dividends are growing. If the dividend growth rate is higher than the expected return, then a more complex multi-stage model is needed. The example here shows a three-stage approach where the stock is expected to have high growth at 13% for 3 years, then lower growth rate of 1% for 6 years, and constant perpetual growth of 6%. This kind of model helps estimate how the stock price might behave over time as this different growth pace play out. You can also estimate the company's worth by looking at the free cash flow available to its shareholders, which is the cash left over after all expenses and debt payments are made and after reinvesting in the business. To find this, you start with the company's profit. Add back some non-cash expenses like depreciation. Subtract investment in things like new equipment. Account for changes in the short-term assets and liabilities. Subtract the money to pay back loans and add any money raised from borrowing. The constant growth formula for this method says that the value of the stock is equal to expected free cash flow to shareholders in the next year, divided by the difference between the return investor expect on their equity and the expected growth rate of this free cash flow. More complex multi-stage models similar to those used for dividends can also be used here. So, using this as our 2011 estimate, we will assume a conservative set of growth rates going forward for a three-stage growth evaluation model as follows. So G1 is equals to 9% for 3 years after 2011. G2, a steady declining growth rate to constant 6% in 2017 and beyond. K is equals to 8% cost of equity. So the specific estimate of annual FA beginning with the estimated value of 2011 of 1,350 are as follows. First, for the high growth period, they're looking at 3 years, 2012, 2013, and 2014. Each year, the amount of money is growing at a rate of 9%. For each of these future amounts, they're figuring out what the money is worth today. And that's the PB, it's percent. So they do this by using a PV factor, which is like discount because money today is worth more than the same amount of money in the future. So they multiplied the future amount by this factor to get the present value for each year. Then they add up these present values for all three high growth years to get a total of 4,126 million. So next, for the declining growth period, they look at 2 years, the 2015 and the 2016. Here, the growth rate is slowing down, 8% then 7%. Just like before, they calculate the present value for each of these future amounts using the different PB factor because it's for later years. Then they add up these present values to get a total of 2,763 million. Then finally, for the constant growth period, they're assuming that after 2016, the money will keep growing at a steady rate of 6%. They take the amount in 2016, 2,020 million, and estimate what the value of all those future constantly growing amounts would be at the end of 2016. They use a formula for this, which involves the future amount, the expected return, 8%. So at the constant growth rate 6%, they gives them a value of 107.50 million at the end of 2016. So to figure out what 107.50 million is worth today, which is the same point in time as the end of 2011, before the high growth period started. So they multiply it by the PB factor for the year 2016, which is 6,806. So they give this a present value of 72,858 million for all the cash flows expected after the declining growth period. So, in simple terms, they're estimating the value of future money by figuring out what it's worth today. Considering different growth paces and a constant rate in the long run. They then add up the present values from all these periods to get an overall idea of the total present value. Another way to figure out what a company is worth is by looking at its operating free cash flow, which is the cash it generates from its normal business activities after paying for things it needs to keep running. To find the present value of this cash flow, you need to discount it back today using the company's weighted average cost of capital, which is average rate of return it needs to pay its investors. The formula shows that the rule of the whole company can be calculated by taking the expected free cash flow in the next period and dividing it by the difference between the company's cost of capital and the expected growth rate of its free cash flow. Here are two important calculations when looking at the present value of a company's operating free cash flow. First, there's another way to estimate how fast the company can grow in the long run. This growth rate G can be found by multiplying the average rate at which the company keeps its earnings, the RR. By how will it use its total investments to make the profit ROIC? Second, to discount the future cash flows back to today, you need the company's weighted average cost of capital, the WACC. So this is the average return the company needs to pay to its investor, both those who own stock equity and those who lead money debt. The WCC is calculated by taking the proportion of equity in the company's total funding, multiplying it by the cost of equity, and adding that to the proportions of debt multiplied by the cost of debt after considering taxes. To guess how much profit company will make her share of the stock, there are generally two main steps. First, sell forecast. You need to predict how much the company will sell. This involves looking at how the company's sales are connected to the overall economy and comparing them to what's happening in the same industry. Second, the estimated profit margin. You need to estimate how much the profit the company will make from those sales. This means understanding how the company competes, how well it has done in the past, and how it fits within the industries. By looking at the both how much your company sells and how profitable those sales are, you can get an idea of its future earnings per share. Relative valuation ratio techniques. The general relative valuation ratio techniques have been discussed in the previous chapters. Exhibit 14.3 contains the basic data required to compute the relative valuations ratios. And Exhibit 14.4 contains the four sets of relative valuation ratios for Walgreens, its industries, and the aggregate market. To understand how Walgreens competes, you need to look at how well they're doing inside the company. This includes considering what's happening in the general industry and how Walgreens itself is performing. From this, you can estimate how much profit they make on each sale. This information can then be used to figure out how much profit they make per share on stock. It's also important to pay attention to their earnings reports every 3 months. These quarterly numbers can help make sure your yearly profit guesses are on track. And if the actual quarterly results are different from what you expected, it's a signal to figure out why. To figure out how much investors are willing to pay for each dollar of a company's earnings, you can look at in two main ways. First, you can consider the big picture, like the overall state of the economy and the stock market. The second, you can focus on the company itself. This involves comparing how much of their profit they pay out as dividends, figuring out the return investors expect from the stock, and predicting how fast the company's earnings are likely to grow. By putting these pieces together, you can calculate the earnings multiplier, which helps in estimating what the company's stock might actually be worth. To understand how Walgreens competes, you need to look at how well they're trying inside the company. This includes considering what's happening in the general industry and how Walgreens itself is performing. From this, you can estimate how much the profit they can make on each sale. This information can then be used to figure out how much profit they make per shares of stock. It's also important to pay attention to their earnings reports every 3 months. These quarterly numbers can help make sure your yearly profit guesses are on track. And if the actual quarterly results are different from what you expected, it's a signal to figure out why. So, to figure out how much investors are willing to pay for each dollar or company's earnings, you can look at in two main ways. First, you can consider the big picture, like the overall state of the economy and the stock market. So, second, you can focus on the To figure out how much investors are willing to pay for each dollar of the company's earnings, you can look at in two main ways. First, you can consider the big picture like the overall state of the economy and the stock market. Second, you can focus on the company itself. This involves comparing how much of their profit they pay out as dividends, figuring out the return investors expect from the stock, and predicting how fast the company's earnings are likely to grow. By putting these pieces together, you can calculate the earnings multiplier, which helps in estimating what the company's stock might actually be worth. Additional measures of relative value: price cash flow ratio and the price to sales ratio. The price cash flow ratio has grown in the prominence and use because many observers contend that the firm's cash flow is less subject to manipulations. Price to sales ratio, sales growth drives the growth of all the subsequent, the earning and the cash flow, and sales is one of the purest numbers available. See this in the Walgreens. Additional measures of relative value: price to book value ratio. Book value is a reasonable measures of value for firms that have consistent accounting practice. It can be applied to firms with the negative earnings or cash flows. Should not attempt to use this ratio to compare firms with different levels of hard assets. For example, a heavy industrial firm and a service firm. See this in the Walgreens in exhibits 14.16 and 14.17. Growth duration model. The purpose is to evaluate with high price to earning ratio for the stock of a growth company by relating its price to earning ratio to the firm's rate of growth and durations of growth. A stock price to earnings is functions of expected rate of growth and earnings per share. In stock required rate of return, firm's dividend payout and ratio. The growth estimate must be considered both the rate of growth and how long this growth rate can be sustained, that is, the duration of expected growth rate. When you visit a company and talk to people there, it's important to pay attention to what the managers are planning, how they intend to achieve their goals, and what worries them. Keep in mind that they can't share information that isn't public, and asking what if questions can help you understand how changes in sales, costs, or profits might affect the company. The managers might also give you a sense of whether your profit predictions seem reasonable. It's also a good idea to discuss the main challenges and opportunities in their industry. Understand how they make their plans, and expecting people with different levels within the company, not just the top executives. Looking at companies within the same business area can help you compare them directly. This can also be another way to figure out a sensible price to earning ratios, which shows how much investors are paying for each dollar of profit. When you do this, it's important to consider if one company is much riskier than the other, or if the predictions for how much they grow might not be accurate. Generally, if the stock has a low price compared to how fast it's expected to grow, it might be worth more than its current price. On the other hand, if a stock has a high price but isn't expecting to grow much, it might be overpriced. And deciding when to sell a stock is important because keeping it for too long might mean you don't make as much money as you could have. If the stock price drops right after you buy it, you can need to think about whether it's a chance to buy more, or if you want might have been mistake of your initial research. It's crucial to keep checking the main things you base on your decisions on. You should also pay close attention when the stock price in the market gets close to what you think it's really worth. And finally, you'll always remember what you bought the stock in the first place and be ready to sell if those reasons of no longer hold true. So for this chapter, I've learned that, or we learned that, figuring out what a company is really worth and whether its stock is a good buy involves looking at many things. You need to understand how the company makes money, what is the future might look like, and how it compares to other similar companies. There are different ways to estimate the stock value, like looking at its dividends or its earnings. It's also important to visit companies and talk to their management to get a better feel to their plans and the challenges. Knowing when you to sell a stock is just important as knowing when to buy. And this often depends on the whether the reasons you bought is in the first place are still valid.